Toolbox seminar online because of COVID. My name's Dino. I'm the convener of the Young Lawyers Committee, and I'm really excited to be able to share this with you in conjunction with the Young Engineers and Engineering New Zealand. So thanks for coming along. I hope you learn a lot of things, because there's definitely a lot that I need to know about finances before I move on with the rest of my life. So I'll pass it on to Hayden.
Hi everyone, thank you for joining us tonight. Looks like we've got about 30 people online at the moment, so that's great. Hopefully there'll be a few more to join us. Might be a bit tardy, but we're going to get underway all the same, and there will be a recording link sent out, so if you do miss any of this, look out for that email. There'll also be a survey to ask how it went. If you've got any issues with audio and that kind of thing, the best advice we can give you is to log out and log back in. It usually seems to fix most things. Like Dino said, it's great to have you here. It's great to have this collaboration between young engineers and young lawyers. We've got a few other events that we are hoping, COVID permitting, to run in the next few months. So look out for, if you're a young lawyer, the newsletter, or Facebook, or if you're a young engineer, our newsletter and Facebook. So hopefully we'll have those to you soon. So tonight's the Financial Toolbox, which is awesome. We've got 3 amazing speakers with us here tonight to shed some light on what it means to be an adult. Obviously, as young engineers and young lawyers come out of uni, we've got an income finally, and now we need to figure out what we're going to do with our money. So it's awesome. We've got MAS who's here tonight, James Smith from MAS. I should move across. Who's going to hopefully talk to us about what MAS offers. And we've got Jared from Hatch, who will do the same, and Caroline from Enable Me. The format tonight is, obviously we're going to have a bit of an introduction to start with, which is what we're doing now. Then we'll move into a presentation from Maz, a presentation from Hatch, and a presentation from Enable Me. We will open for about 5 minutes, some questions after each presenter if you've got anything burning to start with. But we do ask, if you've got something that's complicated and you want a bit of a panel discussion to answer the question, save your questions for the Q&A panel, which will be about 15 minutes at the end. So yeah, if you need to ask a question, hopefully you can see the chat window, which is in the center at the bottom, and chuck your questions in there. Dino, myself, and our friend Tash from Engineering New Zealand will help collate the questions, and we'll direct them to the panel at the end, or at the end of their presentations. So, yeah, I've said this bit, great. So our speakers today are James Smith from MAS. He's an MAS advisor. We've got Jared Searle from Hatch, who's one of the co-founders and head of operations, and Caroline Rennie, who's the director and strategic coach for Enable Me. So without further ado, let's get this underway. I'd like to introduce James. James, if you could turn your mic on now, and we'll get underway with you. Thanks, James.
Cool. Thank you for the introduction, and thanks for taking the time to join us this evening. As Hayden alluded to, my name is James. I'm an advisor at MAS, and I've been tasked to introduce MAS and explain who we are and what we do. MAS, we've been around for almost 100 years, and believe it or not, we're virtually unknown to the general public. We were set up by doctors who wanted an organisation that looked after them. The best thing they did, which has been the key to our success, is they set us up as a member-based organisation. And ultimately, we want you to join us. Being a mutual that's being owned by our members, that makes us different. We don't have shareholders to worry about. It means our sole focus is delivering on member expectations. It's a great space to work in. By delivering on those expectations, we've built a great reputation, winning Consumer New Zealand People's Choice Insurer for house, content, car, and life insurance for the last 4 years. The membership structure has also led us to providing support beyond just our financial products. Our members wanted us to take a strong stance on health and well-being, so we've tackled that in a few different ways. We've launched a health and wellbeing portal with plenty of information and activities available. We've also set up the MAS Foundation. That's a charitable trust with a mandate to fund health research, promotion, and education. We've also chosen to think responsibly with how we invest money, both our members' money through our investment products and our MAS reserves. We avoid companies involved in arms, tobacco, and fossil fuels, and we choose companies who have a strong environmental, social, and governance record in their respective country. We've got a team of advisors around the country whose job is to help you protect whatever that it is that's important to you. All MAS advisors are paid a fixed salary. We don't have sales incentives, commissions, or targets. The idea is that you can be confident that our advice is influenced by anything other than your situation and plans. Let's get started anyway with Insurance 101. The principle is simple. There are risks to your stuff, to your lifestyle and your family. If these things were to happen, the cost to deal with it could cripple you financially. So you pay some money ahead of time so someone else can deal with it. That's what we call an insurance premium. Now, you can't transfer all of that risk. You have to have some kind of skin in the game, managing a small part of that cost before the insurer takes over. This is an insurance excess. You can choose to have more skin in the game, a higher excess, and that will translate to a smaller insurance premium. MAS can protect the things you have now. Your contents, car, maybe a house. These things could be lost, stolen, or damaged. If you crash your car, the cost of repairing yours or the person that you've crashed into could be niggly at best, or at worst, it could bankrupt you. We don't want the worst to happen, so we always recommend to get insurance. You have a choice in insurer. If your values align with MAS, give us a go. We can also protect your lifestyle. We all have bills to pay. We need food, entertainment. We want to travel and feel financially secure now and into retirement. This, your current and future lifestyle, relies on you earning an income. In the same way there are risks to your stuff, there is also a risk of something happening to you. Let's play a game. Imagine you leave here tonight, you have a little dizzy spell, you wind up in hospital with some serious illness. You don't really understand what it is, when, or even if you'll get better. You obviously can't go back to work for a while. How much sick leave do you have? Do you have savings that can cover your bills? How long will that last? How long can your partner or family afford to financially support you? What about your future plans? Are those dreams over? At best, we might have enough to manage in the short term, maybe a year. At worst, you're financially dependent for the rest of your life. It's not a fun game. We're educated, we have access to advice. We can choose to have a plan to deal with all these risks. So if something bad happens to you, your financial lifestyle doesn't suffer. That plan usually involves income protection insurance. If an illness or injury means you can't work to earn your income, this will provide you with a replacement income until you're back on your feet. The excess in this case is twofold. How long can you manage before you need your income replaced? The longer that is, the cheaper the premium. How long do you want your income replaced for if you can't work? The longer that is, the more expensive the premium. I often get asked what kind of costs someone might need to pay to protect their income. So here's an example for you. The key drivers of cost are your age, gender, and medical history. How much income you need replaced, how soon you want your income replaced, and how long you want your income replaced for if you can't work. MAS can remove the financial pain from your family and friends. Now, for most young people, the financial impact of dying is pretty minimal. If you've got a student loan, that gets wiped. You might have some other debt, maybe the cost of a funeral, but once you factor in your KiwiSaver balance being paid out to your estate, maybe that will cover it. If not, and it's important to you, then life insurance might be for you. The key thing is that you should be reviewing this every year as your life change and lifestyles change as we take on mortgages and start families. Whether you're saving for a first home or wanting to retire early, we can help with our KiwiSaver and retirement savings plans. We've chosen to be an active fund manager. There is debate within the industry as to whether active fund managers provide a better run for the fees charged when compared to passive managers. Obviously, returns and fees are important, but the main reason we've chosen to be an active fund manager is it allows us to better implement the responsible investment strategy that our members have voted and said that they want. We apply that strategy to all the investment funds we offer. We're all in. Having KiwiSaver is one thing, getting it to work for you is another. One of the ways to do this is through choosing the right fund. Each fund carries a different level of risk and potential return. The main driver of risk and return is what percentage of fund is being invested in growth assets like shares. The higher that percentage, the greater potential for higher returns, and the greater the volatility it is likely to experience. Just on this slide, just got an example of how different funds are made up of income versus growth funds, and how this mix changes from the conservative fund right through to the aggressive fund. Now, choosing the right fund isn't something you do once. You should be reviewing your fund choice regularly and asking yourself the following questions. People often work off general guidelines. The shorter your investment time frame, the less risk you take on. That way, you're limiting the risk of negative returns when you need your money. That might be okay for some people, but there is no guarantee it is the right for you in your situation. I'd recommend getting advice specific to your plans. Most young people I meet are wanting to use their KiwiSaver for a first home purchase. For many, it'll be the bulk of their house deposit. There are two options here. You might be able to use one, you might be able to use both. The first rules are you must have been a KiwiSaver member for the last 3 years. There's no wriggle room here. The rules are the rules. You must not have held an estate and property previously, and you must intend to live in the property. It's not meant for investment purposes. Meet those rules and you're eligible for the first home withdrawal, effectively withdrawing all but $1,000 from your KiwiSaver account. If you're buying a house with other people and you all meet the rules, you can make the withdrawal together. The Home Start Grant is where the government provides additional money towards your deposit. The amount differs depending on how long you've been in KiwiSaver for and whether you're buying a new or existing home. It does come with extra rules around what your income level is and on the value of the property you're buying. And just further to that, when you are looking at your first home, we do have an MAS team that works at Westpac. And so all MAS members have access to preferential lending offers to do with special rates and discounts, etc. So that's something further we can discuss. So in summary, MAS is a member-based organisation, and ultimately we want you to join. We can help out with your insurances, your investments, and your loan needs. And just a reminder that you should be reviewing your insurance and investment plans regularly. Thanks, guys. Are there any questions?
Cool. Thanks for that, James. Awesome.
Thanks, James.
Looks like we haven't got any questions. I'll just remind everyone that there's a chat window, which is in the bottom right. So if you do have any questions as you go along or think of anything as you go along, please don't hesitate. Use the chat window. Write anything down that's crossed your mind, or save it for later. We'll have a Q&A panel at the end as well. So thanks, James. Without any questions, we'll move on to Jared. So Jared, if you can hear me, please turn on your mic and video, and we'll pass on to you. Awesome.
Cool. I'm assuming everyone can hear me. Just going to crack on. Sweet. Thanks, Natasha. Cool. So I am. My name's Jared. I'm from Hatch. I'm one of the co-founders of Hatch, and I'm the head of operations. Am I controlling the slide? I think I'm controlling the slides, am I? Yes, I am. Cool. So at Hatch, we believe that Kiwis deserve to up their wealth. So what does up their wealth mean? Well, in today's environment, it means putting your money to work. So 20 years ago, you investors, or you, could earn a risk-free rate of return by putting money in a bank account, in a savings account. Essentially, you could essentially get 10% return on that money every year. So if you had $10,000, you made $1,000 in interest every year. If you were lucky enough to have $1 million, you earned $100,000 in that year. That's called risk-free return, and investors love risk-free return. Unfortunately, we're now living in a very different economic environment. Global uncertainty, pandemics, reserve banks all over the world are driving interest rates down and are signaling that interest rates are going to stay low for a very long time. So cash is no longer a risk-free asset. Interest rates are 0%. Cash doesn't offer any potential for high returns. And investors still need returns. So if you think about your KiwiSaver dollars and your institutional fund manager that is directing those dollars, they're still expected to deliver a year-on-year return. And retail investors like your mum and dad and your mates, they want to grow their wealth too, or at least they want to store value that they've built up. So increasingly, when we're asking the question, invest or save, we're seeing that the answer is becoming invest. We love that, and it's not just because it's good for our business, but because more and more money is flowing into equity markets, and it means investors are buying businesses. When money flows into businesses, innovation occurs, unemployment drops, economies prosper. It's all good stuff. Which sort of leads me to my second point around how do we invest. So there's been a lot written about millennial investors using low-cost brokerage platforms to swing trade and manipulate markets and place bets on increasingly volatile markets. We believe at Hatch that the best investors are buy and hold investors. They buy into businesses they believe in, and they hold for the long term. Traders look at news, they look at momentum, they look at fluctuations over the short term, and they make lots of in and out movements. And the only person, or research shows that the only people who win when people are trading are brokerage platforms who make money on each transaction. We fervently believe in buying businesses you're passionate about and holding them over the long term. So you can do that. You can do that by a couple of ways. You can invest in companies. Or you can invest in funds. So you can you can buy shares in businesses like Tesla, Square, Shopify, Lululemon, Nike, or you can invest in funds. And funds are like baskets of shares. So they often have a theme attached to them. So you can buy into the S&P 500, which gives you a holding of the 500 largest businesses in America in one transaction. Or if you believe in diversity of thought, improving business outcomes, you can invest in a fund that buys you a basket of shares of companies that have women in leadership positions. So that's sort of like the two different types of investments that you can make. In terms of when to invest, the saying goes that the best time to invest was yesterday. Timing the market takes either serious luck or skill acquired over years and years of professional investing. Time in the market beats timing the market every time. It's especially true if you set yourself long-term investing goals. So if you have been following the markets, you will see that every year market analysts or investment analysts have been predicting a market collapse over the last decade. Over that time, share markets have been on an absolute tear, and if you listen to the doomsdayers, or if you're too frightened to get in because you read an article, you'd be missing out on significant returns. So time in the market beats timing the market every time. You guys are all young. It's in your title, the young engineers and the young lawyers. So you have time on your hands. What I'd suggest, what I always remember actually, is the CEO of Kiwi Wealth, Ian Burns, a lovely fellow, telling me on one of my first days of work at Kiwi Wealth is one of the biggest risks is someone squirreling away their money in term deposits or saving accounts over their working lives, hitting 50 and waddling along to a financial advisor with what they think is a significant amount of cash, and having that financial advisor tell them that they've missed out on a lifetime of investing opportunities. So in terms of like top tips, I'd say if you've done this before, if you're investing currently, write down your investing goals. Buy businesses or funds that you believe in, invest over the long term, and ignore noise. Ignore the noise. Writing down your investing goals and having a strategy helps you ignore the noise. If you've never done this before, then figuring out a way to get you need to figure out a way to get started. I really like the example of just taking $100, something, the amount of money that you would typically spend on a night out for dinner, and commit to investing in a company or a fund that interests you. Watch and learn what affects that company, watch and learn what affects that investment, figure out fees along the way, figure out how FX rates affect your value, what dividends are, but more importantly, become an investor in a business and see how that feels, and figure out how great it is, and really start your journey around becoming an investor. Which takes me to what is Hatch. Essentially, we give you easy and affordable access to the biggest share market in the world. So it's brought to you by Kiwis for Kiwis. We have 55,000 Kiwis who have invested through Hatch, who are investing in some of the world's most interesting brands, and they're backing what they believe in. We're only just, to give you an example of the US share markets and the sheer size of this thing, compare it to the NZX, which is, the NZX is a list of all listed businesses on the New Zealand Stock Exchange, and that has a combined market capitalization, and market capitalization is a fancy word for share value of $170 billion, and that is a little less than Nike, which is the 33rd most valuable company listed on the US Stock Exchange. So the size of the US market is vast in comparison to little old New Zealand. We have over 3,000 companies available to invest in through Hatch, and over 900 funds. We're not stopping with the US share markets. We're introducing other markets for Kiwis to invest in, and looking to provide other services that Kiwi investors need, like help with their taxes, helpful advice along the way around constructing their portfolios, and even engaging, building a more engaging KiwiSaver experience. I think having worked in KiwiSaver for a while, it's a pretty disengaging investing experience. You basically sign up to KiwiSaver when you first get employed. You pick your fund, growth, and then you pick your the amount that you're going to contribute, and then you're done. So we like to give Kiwis a slightly more engaging investing experience, and we're looking to add services to our US market offering as well. So why Hatch? Well, Hatch is a Kiwi Wealth company. I mentioned Kiwi Wealth, their CEO, before. We're part of the Kiwi Group Holdings, which is a government-owned group that also owns Kiwi Bank. So we're not a startup. We're here for the long haul, and we're really passionate about Kiwi investors and giving them a great experience. Through Hatch, you own your shares directly, which gives you a true seat at the table as an investor. We have hundreds of Kiwis attending next week's Tesla AGM with Elon Musk because of the investments they've made through Hatch. So they get to vote on important company decisions, which is a right that's typically lost when you're investing through a custodian, which has been the typical model that's been at play in New Zealand. So you give someone else the right to vote on your behalf. And we fundamentally believe that part of the investing experience is having a say at that table. You pay for what you use on Hatch, so we're a transaction-based business. We make money on foreign exchange fees. So as you move money into the US, you pay us 0.5% on the exchange rate. And once the money's in the States, you can buy and sell shares for $3 US, and for up to 300 shares, and every one, a cent for every share after that. But that's semantics. It's $3 US. We have no minimums, so I was encouraging you earlier to get started, start with $100 and invest in something. You can do that because of a thing called fractional share investing, which allows you to buy $100 worth of Amazon. And it doesn't matter that typically it would have taken you $3,000 to buy one share, and you had to save up that amount to get one share in Amazon. Now you can buy a slice of Amazon for that $100. And lastly, but I think most importantly, is you can join a community of Kiwi investors on the Hatch Investors Club who are sharing their journey with each other and learning about what it means to be an investor in businesses. So I look forward to that's me done basically. I look forward to answering any questions that you've got. The thing I'll leave you on is a great place to start. If you've never invested before, then Google the Hatch Getting Started course. It's a fun, quirky 10-day course. It will guide you through everything you need to know to become an investor. There's no jargon, no boring stuff. There's quizzes and all sorts of things. 10 days worth of emails, and it's a great place to start. But for now, thanks very much for your time. I appreciate you guys inviting us along to present here today.
Thanks for that, Jared. Well, if you're all right, Jared, we'll ask a couple of questions. I'm just going to turn my mic on and off as I ask them, just so there's no feedback or anything. So the first question we're going to pick out is from Ella, and she's asked, when you're talking about long-term, how long is long-term? So I think she's talking about long-term investments. If you could elaborate on that, that'd be great. Thank you.
Yeah, so it really is dependent on your situation. I've sort of taken it as you guys are starting your careers, and so you have time on your hands, and long-term for you could be, it could be 20 years. You could be making investment decisions because you think this business is going to be around for the next 20 years, and you think it's going to change the environment, it's going to change society, it's going to change the whatever you're making that decision for. So it could be 20 years, or it could be long-term, could be 5 years. You could be investing for 5 years, and that would be considered long-term by some. But it's basically just being at the point of making a decision on a business. It's making sure that you're buying that business for the right reasons. You're not buying it because of hype. You're not buying it because of short-term noise. You're buying it because you believe in it, and you want to hold that thing over a long period of time.
Cool, thanks, Jared. On that, I guess, the long-term point, a lot of our members will be probably saving for a first home. So the question that Dino and I sort of had is if you could please elaborate on the liquidity of your shares and how the platform works, how you sell your shares if you wanted to take, I don't know, if you'd invested 10 grand or something and you wanted to take part of that out or what have you to buy a house, and how that might work.
Yeah, so it's completely up to you. So you can, it's self-directed. We're an execution platform. So we give you access to these 3,000 companies and 900 funds. You can buy into them on one day and sell out of them the next if you want to. It's completely self-directed. We don't restrict any in and out movement. So yeah, if you're looking to invest in slightly shorter term time horizons, like a 3 to 5 year period, because you figure out that the money you're saving for your house is no longer earning you any interest sitting in a bank account. You need to kind of make some kind of gain on it. You can invest over a shorter period of time, and you can pull that money out as and when you require it. And,
well, thanks, Jared. I'll then go back.
Sorry, you mentioned something about liquidity as well. The size of the US market means that there's lots of volume trading on these things. So there's very rarely any instance where you go to market and request to sell your shares and the market isn't there, which can often happen when you're investing in a smaller market like New Zealand. You can go to the market and try and sell your shares and there's no one on the other end of a trade. With the volume and the size of the US market, that doesn't happen all that often.
No, that's a great point. I'll go back to Will's question, seeing as it seems to flow on, and he's asking about if he invests all his money, is there a potential that he could lose all his money if there was a collapse? And I think that's...
Yeah, so I mean, that's why we sort of encourage you to get started. Like we don't think, like sure there is the possibility for you to lose all your money if you invest in one company, because companies do go bust. And if you put all your money in one company, you would lose all of that investment. However, if you were to do a fund, for instance, and you were to track if you were to buy the S&P 500 today, it's very unlikely that the value of the 500 largest companies in America is going to go to zero. And so if you invest in a fund, you're diversifying your investment to mitigate that risk of losing all your money. And likewise, if you're buying multiple businesses, it's less likely you might get one of them fails, but the other 10 or 15 that you invest in, sort of mitigate that risk of it going to zero. But we do say that there are risks involved in investing, and you have to be conscious of those things. But I do think that the bigger risk is sitting on the sidelines and being fearful and not getting in and getting started. And obviously, you're at the start of your career, you can take that $100 that you would have spent on dinner tonight, going out with your mates, and get started and get a feel for it, because at that point, you get a lot more comfort about what the real risks are and what the likelihood is of it collapsing and losing everything. So I'd say just get started and try and get comfortable with the risks involved with investing.
Easy answer.
Cool, thanks for that. And last question with the time that we've got. In your opinion, points of difference, the biggest ones between Hatch and Sharesies, perhaps for all of us who don't know the detailed differences.
Yeah, so I mean the biggest difference is the way the shares are held. So the example I gave of hundreds of our investors being able to go and attend the Tesla AGM and vote on important issues within that company. Because of the way our shares are held, they're held directly, in street name for the benefit of you, the investor. They're not held by a custodian. It means you get more rights and more access to benefit from your investment. So that's the main difference. And yeah, but I mean, Sharesies are doing fantastic stuff at within this market as well.
Awesome, thank you, Jared.
Thank you.
We've got a bunch of questions which we'll save for later, but for now we'll move on. So thank you very much for your time and for your presentation. If you've got more questions for Jared, please don't hesitate to ask them. We're collating the questions that haven't been asked, and if there's anything that hasn't been asked, please let us know. We also will have an email that goes out later with some contact details and that sort of thing. So if something that you is burning, or you're worried that you can't ask the question on the chat, or you want some some individual feedback, you'll get those contact details to get in touch with the right person. So again, thank you, Jared, and we'll move on now to Caroline from Enable Me. So welcome, Caroline.
Caroline, I'm Caroline from Enable Me, and can everyone hear me?
Yes.
Yeah, brilliant. Hey, so tonight I'm going to talk to you a little bit about Enable Me, what we are, the space that we operate in, and how we support you guys to kind of pull all the bits of the puzzle together around some of the things that even Matt and Hatch have talked about. And where we start in terms of Enable Me is we start around you. So we are program-based, we're a fee-based financial advisory. We actually call ourselves financial strategists. And the point of Enable Me programs is to understand your life goals and your plan. So essentially, your finances are a mirror of your life. And for some of you, that will cause you to smile, and some of you, there will be a bit of like, oh, well, that tells me a lot. And what we do is help you as financial strategists to gonna get a sense of what you're capable of and what are the things that you're trying to achieve. And given age and stage and where you're at, there will be a number of things that you're wanting to do with your lives. And it's kind of, how do I know that I've got the cash and the means available to make these things happen over my life journey? And some interesting statistics about that life journey is that now we're predicting for a 100-year life. So for the kind of people in the middle age, that used to be kind of 30s to 50s, now it's essentially 40s through to well into late 60s. And it also means that the way that we used to think about growing our life has shifted. So your parents or your grandparents may have talked to you about, you get an education, you get a career, and then you retire. And now I think that that word retirement's kind of a bit of a gone word. It's really the thing you're going to do after the thing you're doing now. So your early stage in terms of your investment about what essentially is your human capital, that asset you are creating, and that is an income earning source for yourselves, is you. And so your core to any plan and your capacity to do stuff is driven about you. And one of the things to think about in your life is how you manage your careers and how you think about your opportunities and how you're wise with those sort of jumps and the transitions that you make. But expect to be making them over this 100 years. At the moment, you've got the gift of time. And so as Hatch, Jared was just saying, long term can be very long term, which means that you'll weather the storms around any investment opportunities that you're looking to do. So backing back up to that and thinking about, well, I'm starting early in my journey. What are some of the things that I need to be factoring in? And one of the big ones, there's three really. There's potentially you would have come out with some student debt. So that's a quasi form of short-term debt. You may have incurred some just classic short-term debt just because you needed to get stuff, and you might not have had cash to allow for it up till now. And then there's the other big one, which is potentially the mortgage that's attached to the first home. And it's trying to think about how do you factor in what your means and your access to your cash is that allows you to then to make these to essentially to get into your home. So let's talk a little bit about what we know about the truth about money. That we know that you've been given some income. Assume you're all working, cash turns up in your bank account, and given that you will have many calls on this cash. You'll have your immediate things that you want to do day to day, and you'll have those longer term things that you're trying to plan ahead for, potentially one of the big ones being home ownership. And I'm going to circle back to why home ownership is such an important consideration to kind of factor in. And then the other calls on your cash are potentially the sort of things that, like Nath talks about around insurance and how your risk profile protects yourself, both at your personal income and how critical that is to you, and some of your other assets. And then thinking about some of those investment strategies around shorter term, potentially pre-ownership of a property, maybe dialed back down while you're trying to nail that mortgage, depending on what your means are and what you're capable of doing. But I'm certainly a big believer of getting some insight and involvement into those other markets other than just KiwiSaver, just because it does give you, it informs you, you learn while you're doing that. And then while you may put most of your cash, your spare cash, back into a property, you still have a sense of what it looks like to invest into these other into other businesses and that whole kind of financial sector. It's not it no longer becomes a black box to you, and then you become more agile in terms of how you can access it over time. But the thing about money is that it's a combination. To be financially successful isn't just about understanding how financial markets work. It's actually about, yeah, we need a bit of financial literacy. We need to understand what a mortgage does. We need to understand some of our debts. But you also need to be aware of your mindset about money and your behaviors. If you can believe you can make stuff happen in your life, if you believe that some of these journeys that you're on and your dreams that you're trying to achieve for yourself, then if you believe that that's something that's attainable for you, you'll work towards creating the means to make it happen. And then it's about saying, well, that's fine. How do I identify my right strategy for me? And then how do I implement that and know that I'm on track? And that's where Enable Me kicks in, is we help you to kind of work out, calibrate where you're at. We help you to get a sense of the means that you're capable of. And often people underestimate what they're capable of. They'll often let themselves fritter away money thinking, I can't do this. I can't save enough for this house. I haven't got the capacity. Where it's sitting right there. It's about being smart and wise about how you're applying your money. And then that kicks in this whole idea around your behaviors. And it doesn't mean living a deprived life. It doesn't mean to say don't go out and eat or enjoy time with your friends. But it's about understanding how much of that do I want to do vis-a-vis the opportunity I'm going to create for myself to own a home, the opportunity I'm going to create for myself to grow wealth. And if you can calibrate that within your pay packet, then you can really build up a life that gives you access longer term. So there's this saying, and I usually say it to the next stage of people, other than like you're at the earlier stage, but there's this stage about that people often come to meetings with me and they bring two people. They bring their current selves, which we need to be really good about what they're doing around their money and their resources, and they bring their future selves. And we want those future selves to be able to dance a happy jig in sensible shoes. Now for you guys, there may be many shoes that you wear along the way. And there may be the shoes that you wear, the stiletto wearing shoes, the traveling shoes, the parent wearing shoes, and before you even get to the sensible shoes, but how it's about knowing what you're capable of around achieving those things that are core to the life that you want to have access to living. And so therefore, it's about understanding your cash. So Enable Me tends to, we have kind of 3 broad programs that we offer for people. There's one what we call as Find Your Focus. Now that's your pre-buying a property and you're saving for that, and we give you a sense of the pace in which you can actually put together that deposit, and often a lot faster than you think. And it's usually because we help you to identify what you really need to be wanting and spending money on. Not so you're deprived, but that you're focused on it. And then the next one is when you get into that mortgage, we run a formula and a way of paying down your mortgage that we average around 10 years. So if you are bringing in income at around 120 or more, then you can pull down your the sweet spot is around 120, 130, and you start being able to pull down any debt to around that 10 to 12 years. But it depends a little bit about making sure that you don't overstretch yourself around how much debt you take on. When you're below 100, you really kind of need to gang in with some other people to kind of get that momentum. But I think the thing that you should take away from tonight is that if you're going to take on a mortgage, it's not a 15 to 20-year beast. That's effectively you're just renting the place from the bank, and it's not good use of your funds. You want to be looking for a property and an opportunity that allows you to be able to get that thing nailed within 10 to 12 years. And remember, there's a lot going on in that 10 to 12 years ahead of you, and there's a lot of calls on your cash. So it's been really wise about not overcommitting to the debt. Now, there's three things that are really quite amazing about the whole idea of owning a property and why you kind of want to get onto it as soon as you feasibly can. One of them is long-term. It's a sweet spot to be able to live in really low accommodation. So cost. So if you can own a house mortgage-free, then you're going to reduce your accommodation cost to down at maybe 10 to 15,000 a year. And that's all they call the cash. Well, hey, you're going to be getting that spot and you're going to be rocking up to Hatch every day of the week with some extra cash to want to do some investments. So they're going to love you. And they also places like whether it's Sharesies or whether it's other forms of investment. And so it's a great place to really strengthen your position, is to get onto the property ladder so you can get those accommodation costs down within a meaningful time frame. So that's like that 10 to 12 years. And the next thing is, once you take on the debt of the mortgage, as far as you know, there's only you, or it might be you and a partner, are the only people in the room that are responsible for clearing that debt on your home. So you want to get on with it, because otherwise you're just renting it from the bank. And you want to make good on that, because you want to get that elephant out of the room. You know, you want to clear it. And it's going to be the first mortgage you take on. It's likely to be the biggest mortgage you'll ever take on. You may decide to upgrade your footprint in your home. You might buy in the Wellington context now, it's about probably an 800K property. So you might be facing like a $600 and something thousand mortgage. But if you decide that, no, we feel more like we want to live in $1 million house, it's still proportionately compared to that first mortgage, it's a small beef. So it's when you can get there and get onto it. And there are ways of getting the deposit together, and certainly coming and talking to us can help you to understand that. You yourself as the income earner is one of the key ones. There is the bank of mum and dad, and so understanding the role that they potentially can have. And the other thing you want to do if they are going to be looking at getting assistance from the bank of mum and dad, is you want them to be able to be working at the time that you're looking to leverage from them. The third thing, which is really important in many markets, but particularly so in New Zealand context, is once you invest, when you're paying down that mortgage and paying off the debt, at the same time you are saving into that property. And so it will be gaining some capital gain, but you don't want to be selling that thing. That's the thing you want to be living in. You want to then be leveraging off that to get another investment property. So, but not all investment properties are the same. And so these are the kind of investment options that we're talking about, and their relative return versus their risk. So, but what we know is if you can get a deposit into a property and then leverage off it, then the return on that is considerably higher than just putting the same amount of money into other forms of investment. In saying that, I don't recommend that you narrow your ambit down to just property. It is a good idea to spread your risk. So the thing about investment properties, about 90% of them can be lemons. So we do have a bit of a formula that Enable Me uses to ensure that you're looking at getting something that's bright, new and shiny. Now that, for some of you might be ready and rearing to go because you've already got a property of your own and you've built up a bit of equity. But for many of you, I think this is potentially it's the next stage in the journey. And so it's something to not lose sight of, that's the opportunity that you are creating for yourself by getting into a home and getting that debt paid down, and that you can then leverage off that. And if you get the right property, it can wash its own face, which then means that you can still use your cash that you've got available, once you're mortgage free, to go into the other managed funds. So you're really then spreading and growing your balance sheet. And that's pretty much me. So as said, financial success is about knowing that you're in control, creating a plan, which a plan is really creating a strategy. What's a strategy? A strategy is about understanding your means, and it's about seeing where you want it. What are the ends? What are you trying to achieve for your life? We care about you. If you're at the center of this, so it's about the life you're trying to create for yourself, and let us help you connect the dots to make that a reality. Thanks, guys.
Awesome, thanks, Caroline. Just questions from Dino and I at the moment. So the first one is from Dino, which is, what's a safe proportion of income to be utilising elsewhere for savings, i.e. investments, short-term, long-term savings, bonds? I'm assuming it's not all of your money.
No, generally the rough proportions, so you'll have a carve off obviously in terms of your accommodation costs. So, and if you're not renting a house on your own, you'll be trying to keep that as low as you can. So you may be about 15% of your income, 15-20% maybe of your income is going that way. Then probably about 25% of your income is kind of happening in that basic accommodation, medical kind of stuff. And then usually you'll spend about between 15 to 25% of your income on discretionary. And if it's getting much above 25%, then you're really starting to, then you're living it up great, but you're really getting in the way of what else that you're capable of. So that should leave you about that 30% of your income roughly, and just allowed a little bit of wriggle in there for you to be putting into some sort of investment. So it's when the question was asked to Hatch before about, well, if I want to draw it out because I'm interested in home ownership, I think that's a very important consideration about where you put those funds short term. So, and that again, that comes back to the center of your plan, knowing that you're capable of home ownership, understanding the significance of it in terms of your journey, and then focusing on making that part of your goals. And then I'd probably say put maybe between 3 to 5% of your funds into other investments at this point in time, so that it doesn't deprive you of the opportunity to own a home.
Cool, thanks, Caroline.
Thank you.
We'll move on to Emma's question, which is the bank of mum and dad a benefit for increasing your initial deposit, or can your parents help you in your first home buying in another way? Which may be a mortgage broker question possibly, but we'll let you answer.
We get in all across all of that. I can help you with that. So there are a number of different ways that the bank of mum and dad can assist. Essentially the bank, so some parents will have cash available that they can put in, and so they can gift that to you. Some of them will have equity that hopefully that they've built up in their home. So then it's about going to the bank and being contributing to the scenario essentially. And so being part in the eyes of the bank, they're part of the team. They're both offering into the equity and then also needing to help to service the mortgage. Now, while in back end, you're the one saying, I'm going to take this debt on, I can service this, and it's worth using the likes of us to check, well, what can you service, without them therefore meaning that you're just renting that house from the bank. But the bank will need to test that your parents can help you out, and that's why it's useful to try and get on taking advantage of that opportunity that they can offer you earlier than later. And it can be a game changer, because it's all about who needs the cash when. And if you can circle back to them and later on and offer that cash back to them as your income earns and grows, they will have allowed you the opportunity to get in much sooner than you were capable of doing.
Cool. I might just add to that, Caroline. What about if, say, you had a friend or a sister or a brother to go in with? What are your thoughts on the risk of investing in property with friends and family? And I know the lawyers online will know a lot about it, but in terms of what kind of agreements could be put in place to protect yourself and that kind of thing as well?
Yep, and I have an example right at the moment. I've actually got 3 guys, so 2 of them are brothers and one's a friend, and so they're right in the process. Cross fingers, they're going to get the house. So it does happen, and so there's a couple of things to work through around that. And as they got lawyers on the line, one is the structure that the house gets put into. And the other thing to think about is that co-ownership sort of agreement. And often with any agreement, and I mean, I trained as a lawyer myself as well as being an economist, so I kind of have a little bit of sense of this. But it's not the good days of the issue. It's how you bail. It's how do you handle when things need to change and you need to back out. The one that we're dealing with at the moment, the recommendations is divide it potentially into a company. Now, the rationale for a company structure is that you can get share ownership that's split equally, but they also have current accounts that attach to each of the shareholders. And so it does mean using and getting an accountant involved, but that doesn't have to be terribly expensive. But the point of that is if there's a disproportionate deposit that each person's putting in, you can then account for that and note it. If each person is paying down their share of the mortgage a bit faster, that can also be recognised and acknowledged. And then the money doesn't need to get messy in terms of who's done what on this. Also means if you want to, if you're living in the house, you can't do the classic company thing, which is like, get the rental income off and offset the expenses. Because of the tax issues, because it's you living there. But if you do rent out a bit of one of the rooms, like you're bailing off to the UK, something, and you get someone in to rent your room out, then you can offset that bit. But again, with all these things, check it off with the accountant and make sure that the tax planning around it is fit for purpose. But it's generally the kind of the way we're thinking about it is making, because you'll all have different incomes and different capacity to clear that mortgage. In this particular situation we're looking at, we've tried to set it so the guys do not have to pay any more than 10 years of mortgage across any of them, even though a couple of them are quite limited in their capacity. And because it's for my mind, it's too long a runway to kind of be working this out between other people. Too much can happen if you go much beyond 10 years.
Great, thanks, Caroline. We'll just quickly go through 2 more and then we'll open it up to the Q&A panel. So we've got one from Pratesh, which is, how much equity do you need to build in your first home before you should be looking at an investment property?
Cool. So the bank will want you to hold out 20% and you usually, if you're doing all right, you can, and if the bank mum and dad have turned up, then you'll want to be putting in 20% to start anyway, because then, in the old days, that's where you used to access the really cheap interest rates. That's actually shifted in this new world. So you could still look at 10% and get the good interest rates, but you need to be to 20% for the banks to really want to be comfortable, and then you want to be building from there. So generally, if you're looking at, certainly the Enable Me investment properties, range between about the 600s up to usually below $1 million. So then that means about 150K you need in addition to the 20% that you've got in your property. But if you're game on and you're focused on it, you'll probably find you'll achieve that within 3 years of owning your property. You'll be circling back with that kind of equity. Remember, you also get capital gains happening in that property.
Great, thanks. And the last one we'll ask before we open it up is, what does a consultation with Enable Me cost?
Not much. So generally we the full Mai Tai generally is about $350. We discount that down. So I usually we discount it to 175 plus GST, and I believe that if you guys can if you get on and do a financial consultation, get it booked within the next sort of 48 hours, then they'll discount that down to $100. So it doesn't, it's not a game breaker in terms of that initial start, and you get a chance to have a good chat with myself and my other colleagues, and at least allows you to get a sense of where you're at right now, and then we can work out with you whether a plan is a good place for you to be at the moment, or whether we'd encourage you to do some of this yourselves and then come back to us within 6 to 12 months when you're just that bit closer to achieving your goals. But we'll certainly give you some clues, some stretch goals to work towards, so you can get excited about what you're able to achieve for yourselves.
Awesome, thanks Caroline. Cool. What we'll do is we'll open it up. We've got a few questions we didn't ask for Hatch. If you've got any questions for Maz, Hatch, or any more that haven't been asked for Caroline, I know there's maybe one that hasn't been asked yet for Caroline, please ask them. Otherwise, we do remind you that there will be an email going out with contact details. And so if you want to get in touch for your own burning questions that you don't want to share, look out for those links. So I'll welcome Jared and James back. If you guys want to turn your mics back on and cameras back on, that would be great. So the question, I'm going to go to one that we didn't ask to Jared previously, and it was to do with ethical investments and whether where does Hatch stand on that and that kind of thing.
So we are a execution only platform, so we have some limits on what can be available on the platform, but it's got nothing to do with ethics. It's got to do with making sure that they are liquid, that the price is not too low, making sure that the market capitalization is high enough so that you're not going to lose your investments, by seeing something tank. We don't have any kind of thing that we put over in terms of you can't buy this, you can't buy that, because we're not making investment decisions for you. We're just simply opening up the shares that are offered in the US markets. So if you choose to invest in something, you're doing that. You're doing your own research. You're making your own decisions.
Cool. Thank you. We just had a general question before that. We couldn't seem to find it ourselves as an answer, but is Hatch app-based, or is it planning to be app-based if it's not?
We're web app-based. So we've started off as quite a lean team. We've got a team of developers. They've built a web application that can be used both on the website, through the website, and also through mobile phones. But it's not an application that you can download from an app store. It's a web-based app, so you can save it on your iPhone or your smartphone, and you save the icon and log in, and it acts like an app, but it's not an app that sits in an app store.
Another question that came in was to do with how Hatch operates, and it says, if you're regularly investing in Hatch, do you pay a fee for every transaction? For example, $100 weekly always incurs a $3 fee.
So no, so you can regularly invest in Hatch. You can set up an automated amount of, say, $100 a week, and that will land in our accounts and be sent to the US. And so we clip the ticket on the exchange at that time. So you'd be paying a few dollars in FX fees, but then it sits in a US account ready for you to have enough money to make an investment. You can choose at what level, what amount of money you want to make an investment at. You can either just leave it there accruing so that you can have enough money to make an investment, or you can set an auto invest. So you can say, I only want to invest when in this stock or this fund when I have $1,000 to invest, because you don't want to be paying large, you don't want your percentage fee to be too high, so you might set it at a certain level that you're comfortable at, and just auto invest. So no, it's not. If you're depositing money in all the time, you can leave it sitting there until you're ready to invest, and at the point of making the investment, you'll get charged the brokerage fee.
Cool, thank you. I've got a question for the whole panel, actually. Probably one of the classic questions you get at these kinds of events. But what do you wish you would have known, or what advice would you give to your younger self if you could do everything again in terms of finances, knowing everything you know now?
Am I allowed to jump in on that one?
Absolutely.
It's really one of the classic things that people say when they come into an enabling program is they wish they'd done this 10 years before. One of the, and I think that I'm quite happy to nod to what these other guys are doing, because I think it's quite valuable as well. I think, but it's about the power of focus. If you get yourself aware of what you're capable of, if you get a plan and you put some strategy around it and then implement it and focus on that, you can achieve so much with your lives. And you can see it in your jobs. You can see it in anything anything you apply yourself to. It's having that same mindset around your finances. It's knowing that this is within your means, and then using these kind of facilities, using things like Hatch, understanding the role of insurance to help to support you in those decisions. It's pretty powerful, just being focused.
Great, thank you. Who would like to chip in next? James, we can't hear you. Sorry.
Yeah, I think it's a good.
No.
Can you hear me now?
Yes. Yeah.
Yeah, I think it's a good point that Caroline raised about just starting early. And when I was younger, you had all the temptations to go on OEs and party it up, and now with COVID you can't get overseas, so you've really got no excuse.
It's so true.
Yeah. Taking the best of a bad situation, but online shopping is so easy.
Think about it. Those interest rates are so low. You're just going to eat principal.
Yeah.
Mine's a bit of a cheat. If I knew what I knew now, I would have invested in Amazon 10 years ago. There's some really funny stuff happening at the moment with Tesla investors. We've got a lot of X0 investors who sold out at a point because they'd made so much money and then saw it continue to rise. And now we have these Tesla investors who some of them are selling out and paying off their mortgages. Some of them are I'm in it for the long haul, and it's just a really sort of interesting thing to watch in terms of a social experiment around how people react to having unrealized gains. But yeah, if I knew what I knew now, I would have chucked some money in Amazon and still be holding it today.
I agree.
Fair enough, thank you.
So I think there might have been one question we missed for you, Caroline, which was from Ella, and it's, "Hi Caroline, it seems like the quality of property in Wellington increases in a big way for each 10k extra you can contribute. What do you think about reaching for a better property, especially early in your career, and putting down less than 20%?
It really is that I was talking about earlier about your means and your ends. I mean, there is some merit in it, especially if you're happy to have some flatmates come in on it to help you out to get that mortgage. But you don't want to be inadvertently renting that house from the bank. You don't want to be taking on debt that you cannot really reasonably chunk down and at pace. And you can come and talk to us and we can run your numbers for you and show you what you're capable of. But you start pushing much beyond 13 years. And remember, in that 13 years, there might be a few other things you're trying to achieve. Yes, your income will go up, but you might want some time out for other adventures that you're trying to undertake. So you just really don't want to like put yourself under pressure and so it's better to pull back on the debt. The people that I see that really make headway are the ones that were prepared to go less than 750 in their first house. The reality is in Wellington now, that's not really a thing. You are pushing around 800 to 900K. So you've got to then be quite thoughtful about how you're going to get that paid off.
Yeah, we'll figure that one out when we get to it, I guess.
Just
So obviously Wellington, Auckland, the housing market, even Queenstown, well, a lot of New Zealand house prices are crazy. But what are your thoughts on, let's say you're living in Auckland or living in Wellington, and your first home you actually bought in Christchurch, or the West Coast or something? I don't know.
Is it the one you're going to live in, or you're hoping that that's going to be investment property?
Well, if you're still let's say you're still working in Wellington or Auckland.
Canterbury's got this wonderful thing about it, and next to Christchurch, you might have noticed it. It's got this thing called land, and it's flat, and so developers can just come along and just keep building more, and so house prices in Christchurch are flat. I have a client that came in and she's like, had an investment property in Christchurch. It hasn't gone up in any form of capital gain in the last 4.5 years. And so Christchurch is a really nice place to live. It's really quite good to get a property for yourself to live in down there. It's quite handy for people because it's low getting in, but it ain't your place to invest. And certainly, West Coast, I mean, unless you've kind of got some connection to it, it's a bit boom and bust. If you want to know over the 10 years that you're going to have consistent capital gain, go where the people are. So go north of Taupo, essentially. Go where the 30% of the people that are all driving back to New Zealand are all going to head to, and there is consistently a shortage of supply there and a demand to want to be in that area. And that's what you're leaning on for capital gain. And you also, I don't know if you know, but 51% of the population, New Zealand population rents. So you also want to be in a space where you're going to have good, regular people looking to rent your property. So, yes, Wellington is a bit of a bugger in terms of the housing stock compared to what you have to pay, essentially. Yeah.
No, awesome answer. Thank you.
Thank you. We've got one more panel question just to finish everything off because the individual questions have started to trickle down. Obviously, with investment savings and shared portfolios, there's always a bit of risk when something can happen, and you never know what can go wrong. And that's out of your hands. But then you've got things like COVID come along that hit the globe, and you still have the power to decide what you want to do with any income you've got residually left over. I guess for us, could you give us an example for each of you of how this pandemic has changed your approach to savings or investments or share portfolios or anything like that?
Yeah, I think if I could jump in, I think the big change for us has been with what I started on, which was the interest rate environment and the reserve banks across the world sort of signalling that they're going to stay low for a very long time, and the fact that I'm not sure it's James. I think is it all right if you mute, mate? I'm just getting some echo. Thanks, bud. So the interest rate environment is such that it looks like it's going to stay low for a very long time and go into negative territory, which means, I think the investments that our parents have made, the way that they've lived their lives, and the advice that they might give us might not be altogether that relevant. I think, COVID has really hammered that home, and for us, we've seen just a huge amount of change at at the types of investors that are being brought into our platform, because they see they see the fact that house prices are so high in New Zealand. They see them possibly going up and it being harder to get on the ladder, and so they're looking for other alternatives, and they've really jumped in with vigor into Hatch, into the US markets, and so it's been the biggest change for us has been just being inundated with people joining the platform and starting to figure out how to become a share investor, and I think it's been something that hasn't happened in New Zealand for a long time. I think Caroline will attest to this. The interest in investing in New Zealand over the last 20 years has been in properties, and it's quite rightly been in properties because the tax incentives are there. There's everything works in terms of making that a sensible investment, but it's whether that's going to remain for a long time, or whether new people into the market are going to be able to call on banks and mum and dad, or whether they're going to have to look at other alternatives. And I think so. Yeah, that's part of what we're seeing with Hatch, is this new age of investors who are figuring out what investing in shares looks like, and trying to figure it into their overall financial life.
And if I can add into that, I mean, the ultimate is to be able to do both. So to be able to have a home that doesn't have a mortgage on it, to be able to leverage off that for an investment property, and then also to invest into the likes of Hatch. I just actually was just communicating with a client actually tonight, just before I came onto this, about what's happening around the economics around all of this. And so one of the key economists that we were talking to, one of the key observations that they made is that, if I just read this little sentence out to you, it says, after every crisis, there's always a bigger gap between those that have investments in assets and those who depend on their incomes. And I think that's true for what I'm saying, and what Jared is saying as well, is don't just lean on that income. Start getting your balance sheet strengthened, start to get some investments underway, and do it when you've got nice big long runways to work off, so that, because crises will keep coming and moving through, if you've got runways you can weather those storms. But it's your balance, having some stuff on your balance sheet is what's going to strengthen your position, and it's going to effectively future-proof you.
Yeah, I agree with that 100%.
Do you have anything to add there, Dan?
That was very nicely summed up by Jared and Caroline. Just one thing that was probably not surprising for me, but might be surprising for the audience, was when COVID hit, a lot of people panic with their investments and want to make sporadic changes. And when something like that hits, there is no point in doing that. You've already kind of missed the boat. And so it was interesting to see how many people have thanked me, I wouldn't say post-COVID, but a few months down the track, for not making any changes and just sticking to the course, because they're in a lot better position now than what they would have been if they had dialed it back and gone a lot more conservative.
Yeah, it's interesting, because we've seen, new investors who have joined in their droves to invest at the right times. So there are times where people are getting scared of drops and selling at the wrong time, but for the most part, a lot of people are just joining Hatch and wanting to buy into this opportunity for lifelong holding of assets. They've I think a lot of the young people now are quite intelligent when it comes to that kind of thing, and they're not necessarily, they've been clued up. I don't know if they're clued up in financial education in schools or something, but they seem to be understanding that, a dip is an opportunity as well as much as anything, and they're less likely to buy into that fear and sell out of positions. They're holding, and I think it's probably a case of cryptocurrency and all these other things that they're investing in, so volatile. They kind of form communities And that's one of the big things I'd encourage you to do, is form a community of like-minded people and just see if you can leverage off of their investing experience as well.
Yeah.
To make sure that you're making the right decisions and that you're not buying into fear and sort of making the bad decisions that James has just mentioned.
If I can just add to that last point, I mean, it's just, I think one of the things about the COVID, it was a real shock to income. And that probably for a younger generation, that's potentially one of the first times that their income has been shocked, or the risk, such a risk to where their income was going to come from. And we still hasn't quite come out in the wash. This is why we're saying that the two things. One, do the stuff around strengthening your balance sheet, and Hatch is a great way to kind of slowly ease in on that. At the same time, make sure you can sort this house thing out. But the other thing is really know what you're capable of. So don't underestimate the cash that you're getting access to and put it to work. I always say we like busy money. We like it to be out there and doing stuff. You don't want it sitting around sloshing, wasting its time. And so think strategically about how you get it busy, and then understand what you're capable of.
Yeah, and I think we don't need to preach to you guys about increasing your balance sheet. You guys are engineers, future engineers and lawyers. You guys have just got a degree where your career path is into business ownership, essentially owning law firms, and what it means to be an owner of a business. So good on you. And I think some of the higher net worths that we deal with on Hatch all seem to be engineers and lawyers who own their business and have serious capital to play with as a result of that. So good on you for choosing that path.
Great one. Well, thank you so much, guys, for your time tonight. And yeah, some really good advice from all three of you. So thank you so much. If there's anyone who's got any last questions, we'll give you about 20 seconds to ask it. Otherwise, we'll do a wrap up. So yeah, thanks again, Jared and Caroline and James. I'm not sure if we can get the slides back up, Tash.
I can see one question that I haven't answered, which is from Ella.
Okay.
Why do you choose to focus on US shares? So the short answer to that is we came from a KiwiSaver business. Kiwi Wealth is a KiwiSaver business where engagement in investments is really, really low. You basically choose your fund, you choose your contribution amount, and then you just let it run. And we wanted to engage our investors. We wanted them to make active decisions because we think that leads to better financial outcomes throughout their life. So US shares is the best, most interesting market to be involved in. You can buy so much interesting stuff, so many interesting things happen on it on a daily basis, and we think it's a great learning experience for Kiwis to go through. And previously it was about $90 a trade to get into before we turned up, so there was that as well.
Fantastic. Well, there were no new questions in that time frame, so I guess wrap up from the two of us. Thanks again, you three from Hatch, Math, and Enable Me, Carolyn, James, and Jared. On behalf of the young lawyers, I'd like to say thank you, and I'm sure.
Same again from the young engineers, yeah. I will run a plug for our next event, which is next week. If you're in the Wellington region and are missing the networking opportunities that we normally provide, you'll be happy to know that on the 24th, on Thursday night, we have a branch and Young Engineers joint event, which is at Max Brewery, and should be advertised on the Engineering New Zealand page. If you could look for that, that'd be great. We'd love to see you all there. If you're a young lawyer and you want to come along, I'm sure you could probably get yourself in there too. I think that's everything. Thank you again to the speakers for your time and expertise. There will be an email going out to everyone who signed up, which will have a link to this event, a recording of this event. So if there's anything you want to go back to have another look at, you can see it. Share it with your friends if you want to pass the knowledge on. And there will also be a survey. Let us know how it went, if there were any issues with sound quality or questions we missed, or there's a panelist that you'd like to see next time. Those are the kind of things that we'd love to hear from you. The Financial Toolbox is an event that both the young lawyers and the young engineers run usually once a year. But if you want to have that more often, or there's something that we didn't cover that you wanted to see, yeah, definitely let us know, please. And the last thing on there will be contact details for each of our three host guests today, from Hatch, MAS, and Enable Me. So all that information will be coming out soon. Hopefully this went well, and yeah, thank you again to our speakers, and have a great night, everyone.
Thank you finally to our main sponsor, MAS.
Cheers.
Cheers, guys. See you,
Thanks,
Jared.
Jared.
Thanks, Jared.